Jay Powell is going to rug us tomorrow, or not. Well, that's what we're going to talk about in today's segment on the Federal Reserve. It's Schumer Siesta coupon code expiration eve. That's right. The Schumer Siesta coupon code finally expires tomorrow for the Me Kevin Alpha report. But for right now, we're going to talk scenarios, and we're going to build them out together. So Federal Reserve scenarios. Here's the game plan, okay? So what is expected? What is expected? We always want to start with this like the base case. This is what the market expects, okay? So the market expectation, we'll go green check mark here. We are expecting with a 96.7% probability that we will get a negative 25 BP cut, and we are widely expecting the vacuum cleaner to pause, okay? Why do we expect the vacuum cleaner to pause, and what the heck is that? That's basically the end of QT. This is the end of an era. QT began in March of 2022. It has been 3.5 years of quantitative tightening, and the end of QT, which is the Federal Reserve selling bonds. Mind you, when they're selling bonds, they're lowering the value of bonds, right? So this has the impact of lowers value of bonds when they sell bonds, right? Because there's more supply. When they stop doing that, they could potentially lead market rates to actually come down because they're selling fewer bonds. We don't have to think about the mechanics of that. Just think bottom line, Fed rate down, and hopefully market rates down. However, usually the market already prices that in. And so we're probably around 4% on the 10-year treasury as just a stable, here's where we sit. If we get a base case from the Fed tomorrow, nothing freaky, nothing scary, what do we get? Probably honestly still sitting around 4%. If we get the end to QT, because QT isn't entirely priced, I would argue maybe 70% priced in for QT. Maybe we end up getting like a 3.9, maybe on the 10. Do we expect some kind of big cratering on the 10-year? Probably not. Broadly, this is the base case. This is what's expected. And if we get this expectation, it should be modestly bullish. So I'd call it modestly bullish. It's nothing scary. It's not scary. It's nothing that makes us really concerned. Now, what should be concerning to you, not markets, okay? Because you know that markets can be irrational. We can make a lot of money in markets. We can, markets can skyrocket, but we can also know that there are bottom line issues in the markets, right? The most concerning thing that you want to pay attention to tomorrow is twofold. So number one, you want to pay attention to any talk about private credit being, how should I call it, systematic, or a systematic risk. So this would be system-wide rather than just idiosyncratic. That's going to be your big oopsie doopsie. You don't want to hear any of that. I don't expect you're going to see Powell say anything negative about this. So I would say expect Powell to sweep this under the rug, right? Keep the cockroaches where they belong, so to speak. Now, previously, we've had him talk about the normalization of the beverage curve may be beginning. Okay, this is complicated, but we talked about this a little bit this morning in the Alpha report. Mind you, we do that every morning before the market opens up. Not only do you get sort of my next 10 stocks to buy for the next 10 years, but sort of my take on, where's the market going to go in the day? Like, is this the day you go call options, or, do we sit out Fed jitters and kind of just wait and see? Those are the things that I kind of plan for in the day. But in the morning report, what we touched on, so the first time I've talked about it, is the steepness of the beverage curve. Now, the steepness of this, it's a little complicated. I'm going to keep it nice and short. But basically, if Powell talks about the steepness, that's all I want you to think. If he talks steepness, I want you to think bullish, okay? If Powell talks steepness, think bullish. Basically, Steep, if he references the steepness of the curve, it's just a fancy way of saying new normal for the labor market, right? If he downplays steepness and says curve should normalize, that's bad, right? Because it means that unemployment recession might be getting closer. Now, obviously, we've been worried about the unemployment market in the labor market for about a year now. You know, we weren't worried about the labor market in 2022. We had a crap load of layoffs in 2022, but remember what happened in 2022? The jobs market was so freaking tight, you couldn't hire anyone. You couldn't find anyone in 2022. So when Amazon fired 28,000 people in 2022, guess what all the people did who got fired? They went and got a better job. They went and got more money somewhere else. You know? So like totally different jobs market. Today, we're firing 14,000 or up to 30,000, which is just a way for them to sort of like tamp down headlines a little bit. Now they're going to fire up to 30,000 people. That's more firing than what we saw in 2022, and it's a horrible time to get fired, mind you. Like, I was talking to Jack yesterday. I'm like, bro, imagine you're an accountant and you got fired along with 30,000 people, and now you got to go find an accounting job. This sucks, especially in the days of AI. And he's like, Dad, this sounds terrible, but what's an accountant? And I'm like, okay, son, have you ever heard of a credit card? And then I start teaching him about debits and credits, and he's like, Dad, I'm 10. Anyway, so we were actually doing that yesterday, though. This is what happens at midnight at the Meet Kevin household. You start talking about accounting. But anyway, hey, you know what? Put him right to sleep. It worked out great. So anyway, the thing to think about is, like, now it's a lot tougher of a labor market if you get fired. And so it's not just 30,000 at Amazon. It's not just the 1,000 at Target or 1,500 at Target or the 1,000 at Paramount, but also UPS. UPS is bragging about how they laid off like 35,000 workers in the last 9 months. Okay, 35 over the last 9 months. That's like 3.8 thousand workers every single month. Gone. Afuera, afuera, afuera. Thousands of livelihoods, man. It's scary. And it's just, like, if it were a 2022 market, fine. Like, just go get another job, you'll be okay. But it's not, man. I mean, you've literally got Walmart bragging about how they want to keep their jobs, their hiring, flat, basically, for the next 3 years. So Walmart wants to grow revenues and not hire for the next 3 years. That's scary. Goldman Sachs says, yeah, we don't want to hire at all for the next, whatever years it is. And then on top of that, you've got, I think they said 1 or 2 years at Goldman Sachs. You've got other companies also reporting that, yeah, no, we're just not going to hire right now. So that's why I say when it comes to the Federal Reserve, if he downplays steepness of the curve, it's good. If he says the curve should normalize, it's bad. Because the curve normalizing with how low vacancies are right now, bottom line, means the unemployment rate's going to skyrocket. If he's like, well, the curve's just steeper today, this is a new normal, it's potentially a sign the Fed's just going to be slow and too late. They're kind of doing the usual, like, everything's fine, the economy's fine, things are bullish. It's just a new normal. It probably means they're going to be too late, but it creates no shock now. And that's in contrast to what they could do in another scenario, which let's talk about the other scenarios. So in another scenario, the Federal Reserve could also come out hawkish. The most hawkish thing that I think we would get tomorrow would be 25 bips, because that's basically priced in. I don't think they're going to shock us. I don't think we're not going to get zero. We're not going to get a hike. It's just they're not going to go for a rug pull on the market. You've got too much funding stress. So too much funding stress to see zero or a hike. It's just not going to happen. I would put this at 1% chance. Okay, especially with that last CPI report we got, 1% chance. So hawkish would be 25 BP and no QT end. I don't really see this happening, but this would, in my opinion, yields up and stocks down. I put this at like a 10% chance of happening. We're probably going to be over here at this sort of base case scenario is probably closer to like 70%. Honestly, probably closer to like, I'll go, let's see, 10. Yeah, I'll go 75%. What there's actually more of a chance of, and I would put this at like a 15% chance, is actually the bearish. So the bearish 50. This is not mega likely, but it's possible. The bearish 50. So the bearish 50, this would be a bearish shock. I think there's a 15% chance of this, so I think it's unlikely. But this would basically be like, oh, SH9T, what does the Fed see that they need to rush to get ahead of, right? That's how the market's going to react to this. And that would also be, like a sell down, because even though it comes across as bullish, like, oh, wow, that's great. Like, cool, we got 50 of cuts. It would be somewhat shocking. I had a course member ask me this morning ago, they're like, hey, Kevin, congratulations. You guys, you raised almost, I think we're at $500,000 now raised for House Hack in just the last 40 hours, which is crazy. I think that's in part because, and I know people, they I wear the Reinvest shirt, so I always like to be clear, like the Reinvest is the new doing business as for House Hack. So we put a little note on the website for that as well. But I think people are looking, they're like, wow, you guys are going to have this Wedge AI, and you've got your AI timeframes on your website, and that you could go see it if you want at reinvest.co. This video is not a solicitation. Read the offering circular, right? But anyway, our renovation AI, like we've got some really cool things coming. We're really excited. Like every day, I'm just like, I'm giddy about this, and I'm working with the AI team. Like, we should do this, we should do this, and they're like, they got to keep me reined in because there's so many things that I want to do. And then we're gonna look at a Nick T article here in just a moment as well. But they're like, hey, Kevin, like, what is what is the potential of us ending the funding round sooner and Reinvest? And I go, look, I'm the no pressure guy, okay? I was the branded Meet Kevin no pressure agent. And I never want anybody ever to feel pressure to invest. And it's very important to know that there's never pressure to invest. I really don't think the Fed's gonna go like double cut tomorrow. Obviously, if the Fed comes out and they do something crazy like, oh, we're going to cut 100 basis points because we're panicking, obviously, it's going to make sense to talk to the board and no longer do a 5% yield on our round where you get 100% of the upside of the stock plus a 5% yield, obviously, right? Because like if rates tank, like why would we do that? You don't have to compete with that. Like I think 5% already is pretty good when money markets are yielding you like 3.75, and that's like you're getting 5% plus the upside in the stock, which I think is valued at a real estate valuation. And has no valuation premium for AI. You know what I saw yesterday? And we're gonna look at this article here, but I saw this yesterday, and I like part of me like wanted to vomit, but the other part of me is like, this is great. But listen to this. Look at this. You can't make this up. Sequoia Capital leads $750 million round for a startup that, quote, uses AI to create slide decks. It's right here in green. It uses AI to create slide decks. Bro, Grok and GPT already do that. How do you possibly get a $750 million startup for basically a GPT wrapper? Like, this is bullshit AI. So in my opinion, there are two AIs. There's like, first of all, you got your generative AIs that are actually good, like whether it's Grok or it's GPT or whatever, right? Like, Claude, Anthropic, whatever. Like, they're good. They're all, have their strengths and similarities, but they're good. And then there are all the startups that basically just ride on the coattails of those companies. And then I'm like, oh, you guys aren't even doing anything unique. What's proprietary about this? And then what, almost $1 billion valuation? This is like, this is stupid. Whatever. Like, we have proprietary MLs at House Hack, and we keep training more. We're like, all right, now we need an ML for this. I don't want to get too detailed into the MLs we have, because there's some of our proprietary edge in how we structure our real estate data. But it's really fun, and I study AI on a daily basis. I love it. I got my AI book right here. But One of them, at least. So what's really interesting about this whole Fed thing is I don't think we're going to get, that's going back to the Fed here, I don't think we're going to get some kind of crazy 50 BP or shock cut, right? So here's Nick T's article. And Nick T's take here is that the Federal Reserve officials have a suddenly pressing decision when they meet this week that has nothing to do with the interest rate cut. It is whether to stop shrinking the portfolio at this meeting or wait until the end of the year, right? So that, unfortunately, is a risk tomorrow that we end up getting, let's go back to this. There is a chance, within this, so 30% chance, no QT end. Within that 75% base case where we get the 25, there's a 30% chance we don't end up ending QT, right? Not ending QT, not great for bonds. People are looking forward to this, maybe a little bearish, but it's mostly bullish. It's going to come down to the wording. I don't even really think markets are going to care about the normalization of the average curve versus a steeper curve here. Again, remember, if you hear steepness, think bullish, because it just means him saying new normal. It's bullish for now. It could also just be blind to history, right? And if you hear normalization, it's bad because of the layoffs, fine. But going back to the Nick T piece here, what do we have here? As recently as 2 weeks ago, the Fed seemed on track for a year-end decision. However, Powell, in a rare speech devoted primarily to technical monetary plumbing dynamics, said the central bank could approach the point in the coming months where it needed to end QT. And that's really because of that pressure that we're seeing in SOFR, which is the secured overnight funding rate. And so the debate is going to be separate from what we're seeing regarding interest rates. Here are the Federal Reserve assets. You can actually see they're basically back to COVID levels, like right before COVID. Well, actually, no, that's not true, because technically the COVID printing started over here. They're just right after COVID. We just kept printing for a very long time. This is probably where the inflation came from. Like, this was the emergency response, and this was probably just the continuous printing that led to all the inflation right here. That's where they overdid it. So the overdid it portion is gone, but the COVID response is still built in the system. That'll probably just stay there forever. But the Federal Reserve doesn't want the balance sheet so big because supplying trillions of dollars of interest-bearing reserves to the bank carries political costs, such as paying larger amounts of interest, but they want to keep short-term rates under control, blah, blah, blah. None of this really matters. It's just basically as a way of saying, as we saw yesterday, we've started to see some volatility in the spreads on the overnight yields. Now, I always kind of like looking just to see what some of the comments are over here. So let's just go to most liked over here. When the Fed purchases securities, it creates reserves, electronic cash that the bank holds. This is basically, printing money to us normal folks, creating value out of thin air. So technically, and I always get a comment out of this every time I say this, it's correct and it's not correct. The Fed doesn't actually print money. The Treasury prints money. But the Federal Reserve changes a number on a spreadsheet that creates essentially debt for the government out of thin air, and the Federal Reserve. And then they print the money, right? So I always think that's very funny. Decentralize. First, the economic sophistry of modern monetary theory must be revealed. You know how many people I feel like just write comments now with AI? It's just like, I wonder how much of the internet is just dead these days. Like, who actually writes their own comments anymore? I know you folks do, but you folks are smart. Somebody says, please bring back the soundboard.
Just close the fucking door. Close the door.
So, anyway, look, that's the preview. Now, what do we actually think that's going to do for markets? Okay, look, I'm going to be clear about this. This morning in the Alpha Report, this is a free sample, okay? This morning in the Alpha Report, I said, folks, today is not a day for puts. Today is probably not a day for calls either, though. I think the Qs sit 6:30 as a floor and hang out. And it's really freaking scary because it's on the dot at 6:30 right now. And I said this in the pre-market. You can fact check this. You go back and watch all my live streams going back to 2018 or there. And you go back into the live stream this morning, it's like, Kevin wasn't mega bullish today, but he also said no puts. I literally said, you know, there are some days, if you're trading the Qs, there are some days you just take off. And today might be one of those days. Now, like, why would I say that? Because isn't that boring? No, I actually think, you know, obviously I can't give you personalized advice, but I think it's really good perspective. Why do I think it's good perspective? Because you go into the Fed meeting, bro. This is so normal. Like right before Fed meeting and then China on Thursday. Come on, man. Of course the market's going to be like, all right, sure, all-time highs. You know, maybe we're just going to kind of chill out and wait just a little bit. Come on. So, like, hey, you know, if you come up with, if you're happy with your own strategies, or your own fundamental analysis, if you're even doing fundamental analysis, great. If you want to see the fundamental analysis that we're doing and the technical analysis every day before the market opens up, almost every day. You know, sometimes I get sick. I actually take a sick day. I call in my boss, but that happens very, very, very rarely. A handful of times a year. And I still try to get the alpha report out, even if I can't go live. But yeah, you know, come join us over there in the Alpha Report. Use that coupon code Schumer Siesta. We're going to expire that tomorrow evening, and then the price will go up. So we'd love to see you there. Let me see what some of you have in the chat here this morning. Somebody writes, Kevin, my strategy is called Taco. Yeah, that's why I sit at like an 8.9 to 9 out of 10 on the Taco scale. Totally agree, man. The taco scale is something else. Okay, let's see here. Then we've got bring back the sound. Well, we got the soundboard for you.
Nice to have you. So you want to talk about lovemaking, right?
How many of your kids did you have to lay off due to AI? You know, I'm actually hiring. All of them are hired. They're great. We call them the Magnificent Seven. The Magnificent Seven children. You know, sometimes we put a little more money into one of the Mag 7s and a little more into the other, but we always try to balance out our allocation to the Mag 7. All right, there's my take on the Fed.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.